Welcome back. The Federal Reserve raised interest rates again. Jerome Powell had some strong words about fighting inflation. Joining our conversation this morning is our local financial advisor, Bruce Allen, to talk about that. Good to see you again.
You as well, Gary.
So what has changed? So last June, the Fed came out with kind of a look forward. What has changed since last June, and how have the markets done?
Yeah, so yesterday we can encapsulate the surprises that the market were absorbing in three areas. Higher interest rates for longer, 2, lower economic growth, and 3, higher unemployment. And we want to talk briefly about each of those three topics, because that's really addressing why the market moved so dramatically yesterday.
Okay, so Powell said, you know what, we're going to have to go through some pain here to get inflation down.
Yes.
How much pain are they going to inflict?
Well, I think the first thing is, if we look at what the Federal Reserve said in June, they said that interest rates by the end of this year would be roughly 3.4%. Yesterday they said no. Now it's going to be 4.4%. And those higher interest rates have an impact on the economy. The path to how we get to 4.4% and even higher in 2023, in November they will raise rates another 0.75%. In December, another 0.50%, and then at the beginning of 2023, 0.25%. The markets were not ready for that. That was a real surprise.
Yeah, the markets have just been tanking lately. It's just been very difficult. So experts also say that with the economy slowing down, which is the goal, by the way, right? That they're trying to get it to slow down, that unemployment may also rise. And what are we looking at there, do you think?
Yeah, so I think the first thing is, when you mentioned how the economy is going to slow down, the Federal Reserve's speaking engagements were saying we're going to have a soft landing. Yesterday, the projection said that instead of having positive growth this year, we'll have likely almost no growth. So we went from 1.7% growth in 2022 to the economy growing at 0.2%. That's Fed speak, Gary, for we're going to have a recession. And so it's likely now that the Federal Reserve is aware that the policies that they are embarking on will likely create a recession. And we've been talking about how the bond market has been predicting a recession for several months now. Now it looks like Jerome Powell and his colleagues at the Fed have absorbed that as well.
So what's the bottom line for all of us? I mean, they're going through all of this to try and get inflation down to help us, but it has other effects too.
It does, and part of what you mentioned, and I didn't get to that yet, was the unemployment picture. The unemployment rate was looking like we would see unemployment in June around 3.8%. Now it's in the 4s, and we may get up to 5. If we see unemployment rise from 3.5% in July, which is where it was, to, let's say, 5%, that would mean that about 2 million Americans would lose their jobs over the next year. And that's the pain that Powell's talking about, and we're going to see that in the jobs numbers, unfortunately. And obviously, nobody wants to see that. Powell's really committed to trying to make sure that we control inflation, but the cost of that on a human toll is that there will be some disruption in the jobs market, and neither you nor I want to see that.
Is this the only tool that the Fed has to try and bring inflation under control? I mean, because it doesn't seem to be working well.
Not yet. And I think that one of the things is that, yes, that it's a tool that they're using right now. They have other tools, but this is probably the most powerful tool, and the lag time to see the impact of these tools is typically 6 to 12 months. Having said that, because the inflation rate in August was so high, especially core inflation, that's what's led to these significant changes in policies, and that's why, one, short-term interest rates jumped yesterday. For the first time since 2007, short-term treasuries are now offering a 4% yield. Longer-term treasuries, actually, the yields went down, Gary, as bond investors bought longer-term bonds to lock up those rates in anticipation of a recession. Stocks fell 500 points, as you know, and the dollar went up almost 1%. So your future trip to Europe is going to be less expensive.
Yeah, well, there is that, I guess. All right. Bruce Allen, always good to see you.
You as well, Gary.
Thank you. Take care.